Welcome back. This is section 3 of Startup Equity Basics. In this section, we're going to look at the rights to acquire equity. Now, there's a couple of different rights we'll look at. First category are rights to acquire equity from the company. The company will be issuing new stock to the right holder. These rights include stock options, warrants, convertible notes. Those are the three that we'll be looking at. A second type of right to acquire equity are rights to acquire equity from other holders. So the stock is already held by another holder, and you have a right to acquire that stock from that holder under certain circumstances. Two common ones: right of first refusal and buy-sell agreements. Okay, starting with stock options. Stock options are a right to buy a set number of shares in the future at a price that we're setting now. This price will be called, or is referred to, as the exercise or the strike price. Stock options are granted under an option plan. This is a formal written plan under which all grants are made. The plan can be called equity incentive plan, sometimes stock option plan. Those are common names. And the option is exercisable for common stock. So these are grants to acquire common stock. These grants are made to service providers being employees, consultants, or advisors who are working for the company, providing services to the company. These grants are compensatory. They're part of the compensation, and they're incentive. They are to incentivize the employee to stay with the company, work for the company, provide best efforts. As a part of that, the option will have a vesting schedule attached to it. The idea being that the service provider has to earn the right to buy these shares in the future. Vesting schedules are typically time-based, so the stock will vest over a period of time. A typical schedule is 4 years, where each month the 1/48th portion of the shares granted vest, so long as the service provider continues to work for the company. If the service provider terminates, they quit, or they're fired, or they leave the service of the company, the vesting stops. And once it stops, they only can purchase the vested shares, the part that they've earned. So in a 4-year vesting, if somebody quits after 1 year, they will have earned the right to buy 25% of whatever was granted, and that's all they would have the right to purchase. Sometimes a vesting schedule will be based on performance or milestones that are met, such as a developer who has to deliver a software program that has certain functionality in it, and that delivery has to occur within a certain period of time. And upon delivery of the software that works successfully, their shares vest, or a portion of their shares vest. Other types of performance can be based on sales criteria or other areas. Second type of right is a warrant. Now, the definition for a warrant looks suspiciously like the definition for an option because they are, in fact, the same. Options and warrants are legally defined the same way and do not have a legal distinction. It is by convention that we use options and the terminology of options for these compensatory grants that we described, and we use warrants for issuances that are associated with financings to investors. So a warrant is granted or issued to an investor and is typically exercisable for preferred stock. It's possible for a warrant to be exercised for common, and we do have those, but more frequently warrants will be preferred stock. Because these are issued not as compensatory, not for services, but for investment, there's no plan, there's no warrant plan, there's no vesting schedule. These are fully vested. Once the investor invests his funds and he's granted the warrant as a part of the investment, he has that right to exercise in the future at any time, as long as the term of the warrant is. Warrants are used as equity sweeteners. The reason that we're granting the investor the warrant is to sweeten up the deal a little bit. Perhaps the financing was negotiated rather hotly. Perhaps the company wanted a higher price per share than the investor felt was appropriate, and as a way to induce the investor to come up to the company's terms and price and invest, the company added a warrant to sweeten up the deal. So that's one way in which warrants are used. Another similar way is in relation to lessors, vendors, lenders who are also offering prices to the company. So you could have a vendor who provides services, typically at a certain price, and in exchange for a discounted, maybe deeply discounted price for those services, the company is going to issue a warrant to the lender, to the vendor. Same thing for lessors. This could be a equipment manufacturer that is leasing equipment for the company to use, discounting the price for a warrant, or even the landlord, the owner of the building that the company is leasing office space in, at a much lower price in exchange for a warrant. Bank lenders, commercial lenders also can often take warrants in exchange for providing a little bit nicer terms. The third type of right that we're looking at is convertible debt. So convertible debt is a hybrid between debt and equity. It's a mixture of debt and equity. The instrument uses a convertible note, which is issued to the investor who's investing funds in the company. And that note is like debt, but it may convert into equity under certain circumstances. Now, this convertible note instrument is usually used ahead of a next financing. So the company is contemplating a financing, but while it's putting the financing together, or before it's ready to put this next financing round together, it needs some small amount of quick funds to tide it over until it closes the next financing. So it turns to the investor to invest in a convertible note, which is a much simpler instrument and can be put together more quickly. And that note converts to equity in the next financing when that equity round closes. It converts to the type of stock that's sold in the next financing. The note will contain some definitions and criteria for what that next financing has to be. So it will specify a certain minimum amount that the company has to gather together for it to be qualified as a next financing. And it will have a time period. The company has to close this next financing within a certain time. If the company succeeds in gathering this minimum amount, closing the financing within that time, the note will convert to that stock. If the company does not succeed, the financing fails, then what happens to the note? There are different possibilities. One is that the note simply remains debt. It is due and payable, and the note holder can call it. That's one. Another possibility is that the note would convert instead to common stock, and the common stock price that would be used for conversion may be negotiable, may be determined by appraisal. Basically, convertible notes are bridge financings. They're sometimes called bridge financings because they provide a bridge to the next financing. The idea being that this is money coming in ahead of the next financing to help the company bridge the gap to put together the next financing, provide the funds it needs to continue operations and to put together this next financing. Okay. So in addition to these rights to acquire equity from the company are the rights we talked about to acquire equity from another party, from another holder of company stock. So we're calling these stock transfer rights because when the right is exercised, stock will be transferred from one holder to another. And the right of first refusal we looked at as a right that's often granted to investors in a financing, preferred stock financing, in which the investors will have the right to purchase a pro rata share of founder stock where the founder is trying to sell whatever portion of their shares they're trying to sell to a third party. So the founder has some number of shares that it wants to sell and it finds a third party who is willing to buy those shares and offer terms for buying those common shares of the founder. But before the founder can consummate and close that sale to this third party, the founder has to go back to the investors who hold this right and offer the same deal to the investors. And the investors have a choice if they want to purchase a pro rata portion of those shares for themselves. So that's the right of first refusal. Buy-sell agreements are much less common. We normally won't see them, but they do occur in companies that are either very closely held, typically where all of the shareholders are family members, and it's a family-run business, or a professional corporation where they're all of the same profession. And what these shareholders want to do is make sure the shares stay within the family, so to speak, so that if one of them is going to leave, one of the professionals in a professional corporation or a family member is going to leave, is terminating services, is leaving the company, they don't want those shares going outside with that person. So there will be a buy-sell agreement, a contractual arrangement under which that person leaving has to offer the shares for sale to the people who are remaining, and the people who are remaining will have a right to purchase a pro rata portion of those shares on a termination. Okay, so what have we learned in this section? First of all, options and warrants are legally the same thing. They are defined the same way, but conventionally they are treated differently. Now, it's important to note that options and warrants are not equity. They are rights to acquire equity, but not equity until exercised. I can't even count the number of times that a CEO has come to me saying, well, we have a holder of 500 option to purchase 500,000 shares. Can he vote those shares? Well, no, he cannot vote those shares because he doesn't own those shares. That he owns only a right to acquire those shares in the future upon meeting certain conditions. Until he actually exercises that right and buys those shares and owns those shares, that's not voting stock and he cannot vote them. He doesn't own it. The only thing he owns is a right to acquire. The difference between options and warrants: options are granted to service providers, usually for common stock, well, always for common stock, whereas warrants are issued to investors and are usually exercisable for preferred stock. Finally, convertible notes. These may convert on a future financing if it succeeds, or it may remain debt if the financing fails. Again, the convertible note is not equity until it's converted. Okay, that concludes section 3.